In this lesson, we'll explore how to use the RSI not just to spot overbought or oversold conditions, but to identify and confirm market trends. First, let's talk about midline 50 crossovers. A bullish trend is indicated when the RSI crosses above the 50 line. This suggests that the average gains over a period are higher than average losses, pointing to an uptrend. Conversely, a bearish trend is signaled when the RSI drops below the 50 line, indicating that losses are outpacing gains. Divergences between the RSI and price can also provide powerful insights. For example, if the stock price is hitting new highs but the RSI shows lower highs, it could signal a weakening momentum and a potential bearish reversal. Next, the RSI can act as a dynamic support or resistance level. In uptrends, the RSI often finds support at higher levels, such as between 40 and 50. If the RSI bounces off these levels, it can reaffirm the uptrend. In downtrends, the RSI may struggle to surpass higher levels, particularly around 50 to 60, which can confirm the continuation of the downtrend. Finally, let's enhance our trend analysis by combining the RSI with other indicators. Pairing the RSI with moving averages can fortify trend signals. For instance, an RSI above 50 aligned with the price above a key moving average like the 50-day MA suggests a strong bullish trend. Additionally, drawing trend lines directly on the RSI chart can help identify momentum shifts and potential trend reversals. By mastering these techniques, you can use the RSI to gain deeper insights into market dynamics and make more informed trading decisions. Remember, no indicator works all the time by itself, so always confirm with other analysis methods.